Recording transactions and events. Introduction. Welcome to recording transactions and events in accounting systems. Recording transactions accurately is essential for reliable financial statement preparation. We'll cover systematic methods for recording various types of business transactions. Understanding these processes ensures proper documentation of all business activities. Types of financial transactions. Business transactions fall into several key categories. Transaction types. Revenue transactions, sales of goods or services. Expense transactions, purchase of goods or services. Asset transactions, purchase or sale of fixed or current assets. Liability transactions, borrowings or repayments. Each transaction affects at least two accounts and must be recorded systematically. Double entry system application. Every transaction maintains the accounting equation balance. Debits and credits review. Debits, DR, increase assets and expenses, decrease liabilities and equity. Credits, CR, increase liabilities and equity, decrease assets and expenses. Example: purchase of inventory. Debit, inventory, asset, increases. Credit, accounts payable, liability, increases. This maintains assets equals liabilities plus equity. The accounting equation in practice. The fundamental equation guides all transaction recording. Assets equals liabilities plus equity. Example: company buys equipment for $10,000 on credit. Debit, equipment, asset, $10,000. Credit, accounts payable, liability, $10,000. The equation remains balanced after every properly recorded transaction. Books of prime entry. Transactions are initially recorded in specialized journals. Types of books. Sales journal records sales of goods or services on credit. Purchase journal records purchases of goods or services on credit. Cash book records all cash transactions, receipts and payments. General journal used for transactions not fitting other journals, adjustments, corrections. These books provide initial transaction documentation before general ledger posting. Recording revenue transactions. Revenue transactions increase company income. Example: company sells $2,000 of products on credit. Journal entry. Debit, accounts receivable, asset, $2,000. Credit, revenue, equity, $2,000. Impact: this transaction increases both assets and equity, maintaining equation balance. Recording expense transactions. Expense transactions represent costs of business operations. Example: company pays $1,000 rent for office space. Journal entry. Debit, rent expense, $1,000. Credit, cash, asset, $1,000. Impact: this transaction increases expenses and decreases cash assets. Recording asset transactions. Asset transactions involve acquisition, disposal, or changes in company assets. Example: company buys new machine for $5,000 in cash. Journal entry. Debit, equipment, asset, $5,000. Credit, cash, asset, $5,000. Impact: this increases equipment asset and decreases cash asset by equal amounts. Recording liability transactions. Liability transactions involve incurrence or settlement of obligations. Example: company borrows $10,000 from bank. Journal entry. Debit, cash, asset, $10,000. Credit, loan payable, liability, $10,000. Impact: this transaction increases both assets and liabilities equally. The general journal. The general journal handles special and non-routine transactions. Used for transactions not fitting other specialized journals. Records corrections, adjustments, and unusual transactions. Example, correction for error in recording previous transaction. Journal entry. Debit, accounts payable, liability, $500. Credit, cash, asset, $500. Essential for maintaining complete transaction records. Adjusting entries. Adjusting entries update accounts at period end. Made to reflect earned revenues and incurred expenses. Ensure financial statements reflect actual financial position. Example, company records accrued expenses at period end. Journal entry. Debit, expense account $300. Credit, accrued liabilities $300. These entries align records with accrual accounting principles. Step-by-step transaction recording. Let's walk through complete transaction recording process. Example, company purchases inventory for $2,000 on credit. Process. Identify accounts affected, inventory, asset, and accounts payable, liability. Determine changes, inventory increases, accounts payable increases. Record entry. Debit, inventory, asset, $2,000. Credit, accounts payable, liability, $2,000. This systematic approach ensures accuracy. Posting to General Ledger. After journal recording, transactions are posted to General Ledger. Example, sale of $500 on credit recorded. Sales journal. Debit, accounts receivable $500. Credit, revenue $500. General ledger. Accounts receivable, debit $500. Revenue, credit $500. This transfers information to permanent account records. Trial balance verification. Trial balance ensures recording accuracy. Prepared after posting all transactions to General Ledger. Serves as error detection tool. Formula, total debits equals total credits. Example. Debits, cash $3,000, accounts receivable $2,000. Credits, revenue $5,000. Balance confirms proper double entry recording. Common recording errors. Understanding errors helps maintain accuracy. Types of errors. Omission, failing to record transaction. Commission, incorrectly recording amount or account. Transposition, reversing numbers, recording $1,000 as $10,000. Prevention, regular reconciliation and periodic audits help identify and correct errors. Internal controls for recording. Internal controls ensure accurate transaction recording. Control examples. Segregation of duties, different people handle different transaction aspects. Reconciliation, regularly comparing financial records with external documents. Approval processes, ensuring transactions are approved before recording. These controls maintain integrity of financial records. In this video, we've covered the systematic approach to recording transactions and events. Different transaction types require specific recording approaches. Double entry system ensures all transactions maintain accounting equation balance. Books of prime entry provide initial transaction documentation. Proper posting to General Ledger creates permanent records. Trial balance verification confirms recording accuracy. Internal controls prevent errors and maintain record integrity. Accurate transaction recording forms the foundation for reliable financial reporting. Thank you for watching.